Over the past year, Caterpillar is up by 12.5%, but very recently they have had a big drop in price. If I jump to the 5-day chart, you can see that after reporting their earnings and confirming a negative outlook into 2025, they are down by 8.7%. So jumping to my stock valuation spreadsheets, let's figure out if at their current trading price they would be considered a buy. I will plug in their ticker symbol and all the metrics will show up automatically. And as always, if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. We are currently running a 20% discount which ends in about 6 days. Now right away, let's jump to the 9-pillar analysis and you can see that the company gets a rating of 9 out of 9. All the pillars are sitting in the green, which is something I love to see. Now, something I love especially about Caterpillar is their high and steady financial growth. Their 5-year revenue CAGR is sitting at 9.63%, free cash flow at 25.28%, and net income at 35.67%. If I jump to pillar 3, you can see that the revenue grew from 41 billion in 2020 to 64 billion in 2024. That's about a 50% increase. Now, if I jump to pillar 4, that is the net income has actually increased from 3 billion to almost 11 billion in 2024. That's a 350% increase. But why did the revenue increase by only 50% while the net income increased by 350%? Well, the main reason for that is that Caterpillar has been growing their profit margin. If you have a look, in 2020, their profit margin was sitting at 7.18%, but in 2024, it was sitting at 16.65%, which it is actually sitting at currently. So over the past 5 years, their profit margin increased by more than 100%, and their return on invested capital actually also increased over the past 5 years, increasing from 9.5% to 14.20%. And what this means is that the company has been using up less money to generate more money, and this is what has been driving the high net income growth. Now, moving to pillar 5, that is the free cash flow growth, you can see that that also increased by about 100% over the past 5 years. But from 2023 to 2024, it actually dropped by about 10%. Now, something I want to show you, something that is very interesting, is that if I scroll down and look at the free cash flow per share, that dropped by only about 5%. Now, what is the reason for that? How come the free cash flow dropped by 10% while the free cash flow per share dropped by only 5%? Well, if I move back to the 9 pillars, you can see that Caterpillar has been decreasing their shares outstanding at quite a high rate over the past 5 years, at a rate of 2.27% to be specific. Now, if I move to pillar 7, you can see that in 2023, they actually decreased their shares outstanding by 3%, and in 2024, they decreased them by almost 5%. These are some big numbers. And of course, by decreasing their shares outstanding, there is more free cash flow to be distributed between the less shares. And that's why the free cash flow per share dropped by only 5%, while the free cash flow itself dropped by 10%. And the reason why I love when a company decreases their shares outstanding is that it increases the value of the leftover shares outstanding, specifically by increasing the free cash flow per share. And so it essentially increases the value of your investment over time. Now let's also have a look at the company's 5-year dividend CAGR, which is sitting at 6.11%. If I zoom in closer, you can see that 6.11% is about 50% higher than the average stock year-over-year dividend growth, which certainly makes up for Caterpillar's lower dividend yield of only 1.56%. Now, something you have to understand is that I'm a dividend investor, a long-term dividend investor that in the long term wants to be able to live off dividends. And that's why I love companies that have high dividend growth. If I jump to Seeking Alpha and move to the Dividend Yield tab, we can have a look at Caterpillar's yield on cost. So if you invested into the company 30 years ago, your yield on cost would be sitting at around 40%, which means that if you invested $10,000, Right now, every single year you would be making $4,000 in dividends, which is quite insane. And that is the strength of high dividend growth. It kicks in the compounding effect. Now, jumping back to my stock valuation spreadsheet, something I also want to point out is Caterpillar's low 5-year free cash flow payout ratio of only 37.36%. And this essentially means that after paying out their dividends, they still have enough free cash flow to push into innovation, share buybacks, paying down debt, and increasing the dividends. And over the past 2 years, it was actually sitting at only 26 and 30% respectively. And so Caterpillar really does have enough free cash flow to increase their dividends, which is something I love as a long-term dividend investor. Now, let's have a look at the last pillar of the 9 pillars, and that is the long-term liabilities over the 5-year free cash flow negative dividends, which is currently sitting at 0.94. and means that Caterpillar, with the free cash flow they currently generate and the dividends they currently pay out, can pay off all their long-term liabilities in about 5 years, which is great, and assures me that if they were to get into some rough times, they wouldn't go bankrupt. And so now that we have gone through the 9-pillar analysis and everything is looking nice and sweet, let's calculate the company's intrinsic value and figure out if currently they are trading at an acceptable buying price. The first thing we want to do in the Grams formula revised is plug in the earnings per share growth estimates. I will plug in the high EPS growth estimate at 18% actually, let's go with 18%, medium at 15%, and low at 12%. And that will give me, when combining this with the analyst predictions, a 5-year earnings growth estimate of 9.84%. And when I combine this with all the other values, I will get an intrinsic value of $281.71, which is actually 30% lower than the current trading price. But we still have 4 more valuation models to go through. So jumping to the discounted cash flow model, I will plug in the free cash flow over the past 5 years and calculated growth rate into the future of 8%. Using the same method as before. I will then use this growth rate to calculate the future free cash flow, and by plugging in a discount rate at 8%, I will calculate the present value of that future free cash flow, and that will give me an intrinsic value of $415.25, a little higher than the current trading price actually. Now moving to the third valuation model, the multiples valuation, I will compare Caterpillar to 2 of its competitors. I will take these competitors' current PE ratios and average them out, multiply them by the EPS of Caterpillar, and get an intrinsic value of $407.38. And finally, moving to the fourth valuation model, we will take the dividend growth over the past 5 years and calculate an average growth rate of 7.64%. Now I'll project the high dividend growth at 8%, medium at 6.5%, and low at 5.5%. And this will give me an intrinsic value of $459.90. And moving to the ultimate valuation, we will average out all the 4 valuation models and get an ultimate intrinsic value of $391, which is 8.16% higher than the current trading price. And with a margin of safety of 10%, let's go with 10%, we will get an acceptable buy price at $351.96, which is a little lower than the current trading price.